Welcome to The Explainer. Today, we are diving straight into a massive 140 billion euro mystery. We're looking at the fascinating and honestly pretty complex mechanics behind Deutsche Telekom. As Europe's largest telecommunications provider and the powerhouse majority owner of T-Mobile US, they're an absolute force in the global market. But there is a deeply intriguing story playing out right beneath the surface of their financials. To really grasp the sheer scale of what we're talking about today, just think about that number for a second. 140 billion euros in market capitalization. To put that into perspective, that is literally larger than the entire economic output of some countries. It firmly establishes Deutsche Telekom as an absolute heavyweight in the European telecom sector. Okay, let's dive into this. To navigate this corporate analysis, we're going to follow a clear four-part roadmap: growth and operational power, aggressive shareholder returns, the valuation disconnect, and finally, the mega merger risk. Part 1. Growth and operational power. When you look at their performance in the first half of 2026, the numbers are nothing short of impressive, especially for a typically slow-moving, mature sector. Organic revenue growth sits at a very solid 3.9%, but here is the kicker. Organic EBITDA growth, essentially their operating earnings, is up 7.4%. They are growing their earnings nearly twice as fast as their revenue. It's a textbook example of operational leverage. Basically, they're scaling up without letting their costs scale with them. Add in a double-digit adjusted EPS growth of 10.3%, and well, you have exactly the kind of momentum investors dream of. So where is all this growth actually coming from? Well, the primary engine is, without a doubt, T-Mobile US. Pulling in 9.6% EBITDA growth and adding 277,000 new postpaid accounts in the second quarter alone, Deutsche Telekom's 54.3% stake is the absolute crown jewel of their portfolio. But hey, don't overlook their home market. Germany just delivered its 39th consecutive quarter of EBITDA growth. Seriously, think about that. That's nearly 10 years of uninterrupted quarter-over-quarter improvement, bringing in 6.5 billion euros in revenue and rolling out fiber to 161,000 new connections. Meanwhile, the rest of the European business is just churning out stable cash flow and really strong margins. They are quite literally firing on all cylinders. Which brings us to part 2, aggressive shareholder returns. Because if you think the operational side is strong, the financial strategy is where this story gets really, really interesting. On August 6th, 2026, the board approved a massive expansion of their share buyback program, bringing the total up to 5 billion euros for the year. And they'd actually already executed 1.2 billion of that by early August. Why? Because CEO Tim Hogeis and CFO Christian Elek are putting their money where their mouth is. They're clearly signaling they believe the stock is trading at the absolute bottom of its long-term valuation range. On top of those buybacks, they have a highly transparent dividend policy, paying out 40 to 60% of adjusted earnings, which pushes the expected 2026 dividend up to 1.13 euros. And the crazy part? They can comfortably afford this. Their leverage ratio sits at a healthy 2.65, well below their 2.75 target, giving their balance sheet plenty of headroom. When you add all of those returns up, you arrive at a truly staggering figure: 10 billion euros. That is the total expected shareholder remuneration for 2026 alone. It's the highest in the entire history of the company. Look, if you're an investor sitting in a somewhat low-growth macroeconomic environment, a massive guaranteed capital return policy like this is remarkably attractive. Now for part 3, the valuation disconnect. Let's just slow down for a second here. We've got incredible operational momentum and historic shareholder returns. So why is the stock sitting at roughly 28 euros when the average analyst target points to over 37 euros? The answer actually starts with a deeply divided analyst community. There is a real tug of war happening over that potential 30% upside. On the bullish side, you've got institutions like JP Morgan raising their target and Erste Group upgrading the stock entirely. But then, on the cautious side, Deutsche Bank has reduced its price target and Goldman Sachs actually removed the stock from its European conviction list. There is a clear divergence of opinion on Wall Street and across Europe about what Deutsche Telekom is actually worth. Let's compare them to some peers to get a bit more context. If you look at traditional US telecom companies like Verizon, they're trading at a price-to-earnings ratio of around 8x. Now, Deutsche Telekom is commanding a higher multiple, roughly 11x. But for that premium, investors are getting significantly superior growth prospects, pretty much entirely thanks to T-Mobile US, along with a highly competitive dividend yield that's securely covered by their cash flow.
The crux of this whole valuation mystery really comes down to one specific term, the conglomerate discount. Think of it kind of like being forced to buy an entire massive toolkit when all you really wanted was the hammer. The market assigns less value to the parent company's varied European operations compared to directly owning its most valuable tool, which is T-Mobile US. Many investors are essentially saying, they'd rather just buy T-Mobile stock directly. This persistent discount is exactly why management is under intense pressure to figure out a way to unlock structural value.
And that leads us to part 4, the mega merger risk. That management pressure leads us perfectly to the absolute climax of this analysis. Back in April 2026, major media outlets began reporting on some persistent speculation about a potential full merger with T-Mobile US. Just grasp the monumental scale of what is being speculated here. We're talking about a combined entity with an estimated market capitalization of $267 billion. It would go down as one of the largest corporate mergers in human history. The discussions reportedly involve creating an entirely new holding company that would issue shares for both entities and potentially domiciling it in a European jurisdiction with a lower tax burden. But standing directly in the way of any such deal is a critical political hurdle. The German government, both directly and through the state-owned development bank, KfW, holds approximately 28% of Deutsche Telekom. That makes the government a massive key decision-maker with a huge say in the final outcome. And that brings us to the core investor fear, which is the dilution risk. If this mega merger were to actually happen, the German government's 28% stake could reportedly shrink to below 18%. Now, why does that matter? Because dropping below that specific threshold means they would lose their strategic minority veto power. It is a massive political consideration. And hey, it's not just the government either. Existing minority shareholders are deeply concerned that a full merger could lead to a massive dilution of their own holdings, creating some serious financial volatility.
And the situation is just as complicated on the other side of the Atlantic. As one Breaking Views analyst pointed out, it is far from clear what it would take to actually persuade T-Mobile minority shareholders to accept this. Think about it from their perspective for a second. Would you really want to trade a high-growth, pure-play U.S. wireless stock for exposure to European telecom markets, which historically have much lower growth rates and entirely different regulations? A merger might not even solve the conglomerate discount at all. Actually, scratch that, it could just expose everyone to even more volatility.
Finally, the verdict.
Let's put you in the seat of the investor and summarize how this risk-reward scale ultimately balances out based on all the source material we've just reviewed. On the bull side, you have an incredibly powerful fundamental growth engine. We're talking double-digit EPS growth, a historic €10 billion shareholder return program, and just stellar execution across the board. But weighing that down heavily on the bear side, you have a persistent conglomerate discount, immense merger dilution fears, and serious structural uncertainty. Keep in mind, this explainer is strictly for informational purposes, not financial advice. But purely as an observer, it is a truly fascinating standoff between operational excellence on one hand and structural complexity on the other.
Which leaves us with one final overarching question to consider. Does the structural complexity and volatility of a potential $267 billion mega merger outweigh the fundamental value of historic growth and returns? It is a €140 billion mystery, and how management navigates this tension is going to define the very future of Europe's largest telecom provider. Thank you so much for joining me on this explainer, and as always, keep questioning the numbers.